6, 5, 4, 3, 2, 1, 0.
Welcome back to Beyond the Ledger. I'm your host, Shardae Layfield, and we are continuing our conversation with Abbas, Raza, and Kyle Ergle. Now that we've covered the fundamentals in part one of our conversation, part two takes us deeper into the strategic and operational challenges of transfer pricing. Let's dive in. And when it comes to pricing, not all services are created equal. So what types of services can be charged at cost? And when do markups come into play? So how do you determine the right markup?
So it really depends on, again, like you said, there's lots of different types of services that companies can perform for each other. But some of the most common are something that we call a covered service. And a covered service is a list of, according to the IRS, is a list of close to hundreds services.
Yes,
and
there's a group of services.
Yeah. And the nature of them are more back office support services. Okay. So be something like accounting and finance or
data entry.
Sorry, yes. And like information technology type services. And if those are identified as such, and you can, they are classified as a covered service, then you can just do no markup, and it's just the arm's length price is just the total cost of services. Okay. Now, obviously, when it's not considered a covered service, and it's maybe something a little more complex, then that's when you have to find an arm's length profitability margin. And that could be, some typical ones. We do management consulting services or engineering services. And that looks something along the lines of 7 to 12 or 15% markup on total cost of service. So that's the range of different types you can do.
Right.
Yeah, so, the markup, it's really determined by that benchmarking that we just kind of described, by the type of service, the geographic location, and the market kind of environment that allows these different businesses to earn that profitability. But the actual calculation of the service fee, you need to include an identification of the costs that go into providing that service. So the direct cost, the indirect cost that we talked about, those need to be what we call kind of fully loaded. And so what that means is that you need to include all of the resources that went into providing that service. And so a lot of companies will include the salary of the person providing the service, but then they forget the rent, they forget the lights, they forget the computer cost, and everything that makes that person able to provide that service. And so when companies, they may do the benchmarking and, we need to charge 7% on the service, but then they only include $100 out of the $200 of costs. And now you only have a $7 profit instead of a $14 profit. And now the IRS or the tax authority may look at that and say, well, where's the other $7 that we need?
Where's the money?
And so that's where companies, I think, can kind of get into a little bit of a corner, is when they don't necessarily calculate the service fees correctly, even when they may have the quote-unquote arm's length markup to support that profit element. The calculation of that profit element is a little bit more nuanced.
And that's where we come in. That's what we help with a lot of the times in implementation of their transfer pricing policy. Once we've identified the transactions, if they haven't already done so, and we have some kind of recommendation of the pricing policy, it's really about the implementation. And once we set up that type of policy or that
it becomes
once we identify, it's streamlined and it's a lot easier for them to. It's not terribly difficult.
But, it's just got to be just in the initial setup of the service arrangement. You just have to be a little bit more cognizant of that you're doing it right the first time. But once you've done it right the first time, doing it over and over again is way more easier. Way more
It's easier. Process is a whole lot easier. So a lot of companies struggle with what to include in the calculation itself. So what should be included in the cost base? And are we talking total service costs, direct costs, indirect costs? What does that look like?
Yeah, so that's kind of going back to what we had mentioned about total cost of services, direct, and indirect costs. And so, like I said, or like we mentioned earlier, direct would be like their salary expenses, how much they're getting paid. It could be on an hourly basis. I mean, there's a lot of different ways that they can be paid a flat rate. And then obviously indirect costs would be, again, like overhead stuff or like costs of subscriptions for like a software that they use to perform their function. But it's not necessarily like one-to-one. Like there could be a group of people utilizing the software, but like, maybe it's the service provider is one guy out of three. So you like can allocate that third of the subscription cost. That's kind of like an indirect cost. Okay. That would be in the total cost base.
Okay.
Yeah.
All right. So shared services always bring another layer of complexity. How should companies approach allocating these costs across entities?
Yeah, so shared services are pretty common amongst groups to have more than basically two entities. So you have maybe your parent company and two subsidiaries, one in Canada, one in Europe. And so the parent company might be providing services or incurring costs that are to the benefit of both entities, or all three entities for that matter. And so then, after we've gone through this process of determining the costs that are included in the service fee and what the markup is, you'll get a total kind of service fee that is associated with that activity by that parent company. Next question is, how do you allocate that amongst all of the entities? Do you give 100% to the UK and 0% to Canada and 0% to the US, or is it a third? Or, what is it?
Yeah.
And so the regulations basically provide that any reasonable allocation key can be used as long as it economically reflects the benefits that should be received by that entity. And so it's a lot of kind of jargon that, doesn't really point you into a really direct answer, but it really is saying like, a company that's got revenue, the U.S. company, for example, may have $100,000 of revenue, and the UK has $10,000 of revenue. So obviously the U.S. is probably receiving the bulk of the activities because they have a lot more to maintain, and the UK is probably receiving some of the services being provided, but probably at a lesser degree in terms of in comparison to the U.S. So revenue, I brought this example up because revenue is a very easy allocation key to implement, and it usually does reflect the economic activity being done for each of the different entities. And so maybe not exactly, but it's reasonable reflection of what they would represent. Something more direct would be time estimates. This is a lot more administratively burdensome to implement, but we're in an accounting firm, so we kind of know what time estimate, time entry is like. But if you had a business and you just basically let them know, like every time you work on the UK entity, you log your hours. Every time you work on the Canadian entity, you log your hours. Every time you work on the US entity, you log your hours. And at the end of the quarter, at the end of the month, at the end of the year, you can just say, okay, 30% of my time went to the UK, 50% of the time went to the US, and 20% went to Canada. And so then you can just use those allocation keys. And that one is pretty precise reflective on how those resources were expended. But it's, again, a lot more administratively burdensome to do. And so there's a whole host of different types of allocation keys. I think those two are pretty common to implement for services, but for IT services, we'll see like number of licenses, so if they have different types of technology platforms that they're working on and they have IT people that help with that, well, if the UK has 90% of the licenses, well, they're probably using the service and need the technical support more than the other entities. And so all of those things we can kind of talk through and see both what probably reflects the economic reality the best, and two, what is the most administratively easy to manage and implement for the company.
Yeah, that's the key. We want to make it as easy for them as possible. There's a lot of times where it's like, transfer pricing is not on the forefront of a lot of these businesses, these multinationals' minds, and we want to make it as easy for them as possible. And especially if it's a kind of smaller company, making it which is why, you're not going to see as many like shared allocation, that whole thing. It's going to be usually something a lot simpler, like those covered services that we were talking about earlier, which is a simple markup, but yeah.
That is complex in some cases. So looking on the other side of the table for a moment, how do tax authorities evaluate intercompany transactions when they're reviewing a company's transfer pricing?
So, tax authorities are first going to look and see if you have an intercompany services agreement. And that's, if you do have one, that's what they're going to base the whole relationship on, because that's the legal memorialization of the transaction. Right. If you don't have an intercompany service agreement, then they're going to kind of look and see if you have, documentation or something that tells them what the policy is. But ultimately, once they get into the kind of the facts, what they're going to look at is what kind of service is it, and then did the markup you use make kind of a high level sense,
right.
And so if you're doing management services and you're charging no markup, then, and it's a U.S. based service provider, they're 100% going to look at that and say you should have added a markup, without a doubt. And then, but on the flip side, if the markup is okay, or if they feel okay with that, they're probably going to want to look and see how that service fee was built up and calculated. Did you use all the cost that was supposed to go in there, or did you leave out the overhead? Yeah. And if you left out the overhead, well, then you also then add enough of the profit element there for their satisfaction. Right. And so that's how they usually look at it. And that's the two main areas that they're going to try to probe at. The next one is a little less common, but it's going back to that allocation. So if they think that you used revenue because it helped another jurisdiction out more and hurt their jurisdiction, they may say you should have used headcount, or you should have done this or that. And so they may try to look at that, and you may have a good, reasonable explanation that once you tell them, they will be like, okay, fine. But if you haven't done any analysis around it, and you haven't really got that documentation in place, right, well, then it becomes a little bit harder to defend your position. Kind of in the present when you haven't done the work beforehand.
Yes, that's kind of the challenge that we obviously face. We're trying to appease, obviously, the tax authority in this country versus this country. Obviously, there's certain instances where a European country requires documentation, and that's where we need to kind of focus on our analysis on. And then also, at the end of the day, helping them with their tax planning purposes, so where they aren't going crazy and they want to obviously reduce their tax liability to some extent, again, while appeasing like a tax authority.
Right.
So,
and transfer pricing is like a push and pull between two tax authorities. So if you make one tax authority really happy, they're not going to go after you, but the other one might, because now you've taken something from them.
They're not going to complain you're paying too much.
That's the thing. You can pay too much and the tax authority is not going to care. It's when you pay too little. And then in transfer pricing, the problem is you may be paying enough or too much or what have you, a sufficient amount in one jurisdiction, but not in the other jurisdiction. So you're always worrying about two tax authorities instead of one when it's transfer pricing.
So every discipline has its common pitfalls. What are some of the mistakes you see businesses frequently make when it comes to transfer pricing?
Common mistakes are, maybe one, they're not even charging the service fee. And so that, again, comes down to which jurisdiction are you kind of looking into. If you're a U.S. Company and you have a bunch of foreign affiliates and you're not charging the service fee, then the U.S. is losing out on that service fee income from the foreign-related parties. So you may be kind of in a pinch if the U.S. looks into that type of arrangement and be like, you should be charging a service fee here. Do you guys not help your foreign-related parties? But those other countries that are kind of receiving the service, I don't think that, the tax authorities there are going to be like, oh, you're not paying the service fee? More money for us. Because that would be a deduction on their end. And so you may not come into a issue in your home country or the country that you're most familiar with. It may come from another country. And that's where I think companies can get a little bit turned around in when they don't have any kind of fee going out at all. And there is some type of service activity that's to the benefit of a foreign-related party. After that, it becomes issues with determining the service fee, not including all of the costs, not having a correct markup, mischaracterizing the service, where they may say, oh, it's IT services. And then when the tax authority looks into what's actually happening, they'll be like, well, no, this is more like research and development and software development services. And so now you have like a mismatch. They're going to do their own benchmarking and say, you charged 5%, you should have been charging 15%. And so now you have this delta of profit that they were going to try to assess on you, essentially. And so all of this can kind of become solved with a little bit of pre-planning. And then with the documentation that we provide, the transfer pricing documentation, that really provides that good level of defense. And then with an intercompany services agreement, that really provides that legalification of the arrangement. And so then I think the last thing that people get in trouble with, companies get in trouble with, is they have that intercompany services agreement and then they don't follow it.
Okay.
Implementing is pretty important.
So
as
they don't follow it, and they have it, but then the tax authority looks at it and says, "Oh, you should have been paying $100,000 a month, but you've been paying $20,000 a month for the last 2 years. Why is that?" And then you'll be like, "Oh, that's an old agreement, and we should have been doing this or that." But there's no amendment to it. There's no termination, or there's nothing to support that fact. What's supporting the facts is this agreement that no one is following for some reason. And for them, that's a red flag, because in transfer pricing, the related parties should maintain arm's length dealing. And so when you go away from those arm's length dealing practices, following an agreement, paying on time, there's consequences to the economic relationship to that party. Because in a third-party dealing, for example, if you're not paying the service provider for a year, you're probably going to be not using the service provider again, or they won't be providing you services anymore because you're not paying, or they may say, you owe us interest now. Now you're loaning money because you're not paying us and you're just keeping the money. So what would a third party do? They're either going to leave the relationship and be like, you don't have to pay us yet, but we're going to you're going to have to pay us a little bit more now.
Give us more.
Yeah. So it's just looking at things like that where companies think they're doing things right, and then usually it's something like they had a controller and a new controller came in and they didn't know there was this service agreement, and then at their old place they did it this way, so they start doing it this way, and 2 years pass, but they've never actually kind of made it whole, And there's ways to change the policy, but you just got to take the proper steps to make sure that you have all your ducks in a row. I think that's the expression.
As long as you have support, you can, and you formalize it, and obviously you stay consistent on implementing that, then there's not much. And unfortunately though, that's I guess where most companies fall short, and that's where tax authorities are like, we can get some juicy revenue because of this. And that's obviously, that creates a whole other deal of trying to figure out, what they owe back to a tax authority, and going retroactively and stuff like that, and trying to determine all the penalties that they have to pay them.
It's like a nightmare.
Yeah. But nobody wants to do that.
No. Why would you? Okay. And of course, mistakes can be costly, like we kind of hear about. What kind of penalties can companies face in their transfer pricing? Is it done properly?
Companies, they can face different types of repercussions if the transfer pricing is not done properly. The first thing that most tax authorities require is that the transfer pricing meets the arm's length standard. So again, that really just means that the related party dealings reflect what would happen with third party dealings. And so that's paramount in terms of the compliance. But after you've met the arm's length standard, certain countries have documentation requirements. And so the U.S. is actually one country where documentation is not required. It's optional. If you do prepare U.S. documentation, it does provide different benefits. It protects you from penalties in case the IRS does do an adjustment for the transfer pricing. And it also shifts the burden of proof to the IRS. So what that means is the IRS, instead of just saying this is how it should be done, they have to prove you wrong. They have to say that they have to prove that what you did was unreasonable. Okay. And unreasonable is different than not correct or correct, And so that's, transfer pricing is sometimes like an art, and so that's where, if you have the documentation, it really does provide a good level of benefit. But as far as penalties are concerned, you're not going to get any penalties for not preparing the documentation in the U.S. You may incur penalties if you don't have documentation and they look at your transfer pricing and make a significant adjustment. There are penalties assessed at that point. Outside of the U.S., most countries follow what we call the OECD guidelines. It's just a framework that's made by the OECD for evaluating transfer pricing. And each of the OECD countries adopt those rules within their local regulations. And so those countries, especially in Europe, they do have statutory documentation requirements where companies have to prepare it. They don't have a choice as far as it relates to their compliance. And if you don't prepare those documentation reports, there can be penalties assessed. And so not preparing that documentation on an annual basis can be anywhere from 2,000 euros to 20,000 euros in penalties, regardless if the transfer pricing is correct or not. Right. You need the documentation. And so then if you provide the documentation, you may not have that penalty, but then they also have the did you do the transfer pricing right? Even if you documented it, are there adjustments, and penalties can be assessed at that point as well. So it's always good to have things kind of squared up before you get into those types of situations. But ultimately, I think for U.S. companies, it's paramount that you deal with and comply with the arm's length standard. And for more high-risk transactions, documentation is usually highly recommended. Outside the U.S., it really depends on the types of transactions again, but if you have a statutory requirement, you have to prepare the documentation or you will be assessed penalties and probably get increased scrutiny from that local tax authority, wherever that may be.
Yeah, and as time goes on, I mean, especially in the EU, there's more and more requirements, or they'll lower the threshold to make sure that they get, because it's just becoming ever more important with obviously more global business and more intercompany transactions across jurisdictions.
It's kind of nice about transfer pricing documentation. Usually in the past, you didn't necessarily have to submit it to the tax authority. You had to have it prepared on time, and if they requested it, you had to provide it and just have it ready for them when they requested it. Now, as Kyle said, they're getting more strict. Certain EU countries, like Denmark, they require you to submit it. And if you don't submit it, the penalties are just automatically kind of assessed. So, especially in the EU, these countries are getting more strict with their documentation requirements. And I wouldn't be surprised if that comes here and everywhere else as well.
Sure. Okay.
More work for us.
Right. I mean, okay. Get some extra work. So to wrap things up with something actionable, what steps should a business take to stay compliant with tax authorities?
Yeah, I think having a list of all the different intercompany transactions they may engage in within the group, having clear policies for each of those transactions that are supported by the appropriate benchmarking. Okay. And that, I think, will get you pretty far. And then the next level of kind of documentation is the reports that need to be prepared on an annual basis, the intercompany agreements, and making sure that you have kind of the accounting records in place as well. So you're properly accounting for the transactions in the books, you're issuing service fees or invoices as you would any other kind of third party, and you're keeping those receipts and stuff on file in case you need to provide it to a tax authority.
Yeah.
Yeah, support.
Right.
I mean, it's also paramount in these types of areas. Companies need to make sure that they're also labeling it correctly. So if you are saying we provide management services, and then on all this invoices you're saying IT services, and things like that. People like it just kind of happens. They're like. For whatever reason, things kind of change. People come in and out of the organization, and those types of things can cause like confusion. It may just be a labeling error from the company's perspective, but from a tax authority perspective, it's like, oh, they're trying to do something funny on us, and it can just kind of cause them to turn over more rocks. And I think in any type of audit situation or interaction with the tax authority, you want them to keep the rocks down. Right. You don't want them to touch your rocks.
No.
Like,
we're fine over
and with all the stuff that Abbas is saying with, identifying these transactions to, formalizing them and having a policy and the planning, and then, of course, obviously implementation, documentation. That's all stuff that us as a practice at Bennett Thrasher do. Like, that's our bread and butter. So any company that honestly is in need of that, then that's what we're here for.
We're here for it. Well, thank you both. Thank you, Abbas. Thank you, Kyle, for being on today and providing all those insights. And I know we'll be getting a lot more business, hopefully, from this. But thank you again so much, and I really enjoyed our conversation.
And thank you to the listeners.
Yes. That wraps up part 2 of our transfer pricing conversation with Abbas Raza and Kyle Ergle. If you found both parts of today's conversation valuable, be sure to follow or subscribe so you never miss an episode. And to learn more about BT's transfer pricing practice and our broader tax and advisory services, visit btcpa.net. We'll be back soon with more conversations that highlight the strategies, stories, and insights shaping the way organizations tackle challenges, uncover opportunities, and move forward.